just 3 years, I went from being absolutely broke in college, trying to figure out how to make trading work for myself, to now living the life that I've always dreamed of. I bought my dream car, my dream apartment, and now have the freedom to do whatever I want. And the exact shift from blowing accounts to 10K days happened as soon as I started treating trading as a video game, by following a system, not my emotions. In this video, I'm giving you the exact model that's changed everything for me and has done the same for thousands of others. So let's get into it. Now, before I walk you through the Mech model, you need to understand why I built it this way and why trading is exactly the same as a video game. Because if you think about any video game that you've ever played, there's certain rules that you cannot break, like fall damage, ammo limits, cooldowns. And you can't argue with these rules. You accept the system or else you die. And trading has the exact same constraints, but now you're just looking at a chart with risk limits, drawdown rules, and certain session hours. Now, in every video game, there's a combo that works. There's a certain meta that all the top players use, and they simply follow that meta. Even if they lose a game, even if they die, they are still going to abide by whatever the meta is currently in that game, whatever that strategy is. And it is the same exact way with trading. Because whether I lose money on the day or whether I make money, it doesn't matter. I'm still going to abide by that strategy. And it's what you have to do in order to become a consistently profitable trader. You cannot care about the outcome on whether or not you make money or lose money on the day. If you just follow your system to a T and try your hardest to stay on side of that winning statistic, then that is where that true profitability comes in play. Because there are so many uncertainties that happen with video games and trading. For example, RNG, different drop loots, your spawn location. And it's the same thing with trading. Sometimes you'll have people speaking like Trump or Powell. Maybe the market moved a lot overnight and now you have to adjust your risk parameters to that. And in the grand scheme of things, your job as a trader is not to know whether or not these uncertainties in the markets are going to happen and what that's going to mean for you, but rather to focus on the inputs that will take you to becoming a profitable trader, which is exactly what I built this 5-step Mech model around, to focus on these mechanical inputs just like a video game. So that being said, let's get into the actual model. All right, step number 1 is to define your higher time frame bias and draw on liquidity. Now, before you even decide an entry and whether or not you're going to go long or short, this is going to tell you what side of the market to play on. Are we leaning bullish? Is the market expanding higher, lower, or are we consolidating? And most importantly, where is price being drawn towards next? Because if you don't have a higher time frame narrative, every trade you take is just going to be a coin flip. Now, this is definitely one of the most common problems I see with every single beginner trader. They will see an entry model present itself on the lower time frame, like the 1 minute, and then just take that entry because that's the entry model. But there is so much more to trading than just this entry model. What I'm going to teach you on the entry model will hold no weight if you don't understand your higher time frame narrative, which is why you need to start reverse engineering your trades around the entry model, rather than just looking at the entry model first and then taking the trade without even understanding what's happening on the higher time frame. I'm telling you, this is the #1 thing that will instantly skyrocket your win rate. If you just take a look through your journal, if you're journaling, at all of the losses that you've taken in the market, I guarantee you the majority of these losses are going to be because you're trading against the higher time frame trend. So I'm going to show you a really easy way to just find the higher time frame narrative and draw on liquidity. All right, let's just take a look at February 4th, Wednesday, okay? I'm going to tell you guys how I was able to find the bias on this day and why I believe that shorts were a very, very obvious play. Okay, so you're going to ask yourself 2 major questions. Okay, so 2 questions to define your bias. The first question you're going to ask yourself is, where are we delivering from? So this is going to be either we're delivering from sell side or buy side. Okay, so how do you actually see where we're delivering from? Well, you're going to look at what sponsored this move, like what made this downward move that we currently had in the markets, right? And I'm starting on the 4-hour time frame. It's really important that you guys use, the 15-minute, the 30-minute, 1 hour, 4 hour. I don't want you to be defining your bias on the lower time frame, like the 1 minute, 2 minute, 3 minute. Okay, really try to stick with that higher time frame to determine your higher time frame bias, right? Now, again, we're on the 4-hour time frame here. Where are we delivering from, sell side or buy side? Well, if we just take a look first, we also have to be taking a look at ES to see if we have any sort of SMTs in the markets. We can clearly see that price is delivering from this high right here, right? There is a sweep on this high on ES. So this is a bearish SMT. If you guys don't know what SMTs are, I did post a whole entire trading free course, so go check that out. Link is in the description below for that if you guys want to check that video out. But it goes over SMTs, right? And this is just a concept where ES ends up taking out a high and NQ does not. not. And that is a divergence in assets, and that's a divergence in the market. So now that we understand that price is delivering from this buy side liquidity, right? We had a stop run inside of this, and we understand that we're now delivering from buy side liquidity. It's now time to ask ourselves the second question, which is what gaps are we respecting versus disrespecting? A simple rule of thumb here is if we are bullish, then bearish fair value gaps are going to get disrespected and bullish gaps are going to get respected. Now, if we are bearish and the draw on liquidity is probably most likely going to be lower, what should this be? Well, bullish gaps are going to get disrespected or ran through, and then bearish gaps are going to get what? Respected. Now, in this scenario here, what can we see with the market? Well, we are clearly respecting bearish fair value gaps. You see that this gap gets respected, and then we have bullish fair value gaps in this leg, and what is price doing with them? We are delivering straight through them. You can see that the market is simply just closing through them, and we are running through it. So bullish gaps are getting disrespected, bearish gaps are getting respected, and we are delivering from what? Buy side liquidity here. Now, when it comes to bias and when it comes to the higher time frame draw, I'm simply just going to be looking to the next swing low in the market. Where's the next swing low resting? Well, we have a swing low right here, and this is our internal low. We also have a swing low resting here, and then we also can be looking more to the left of us here. We have a swing low resting here. And a common problem I see with a lot of people is they just don't understand like how far to look back, or like, I didn't know you can look back all the way this far into the market, and how much should I look, into the intraday of price action? Well, it's really going to be dependent on where we are in the market, right? If we are clearly delivering towards these levels, well, I'm going to be marking out these levels and expecting price to run towards these liquidity draws, right? So the market is clearly trending towards these levels. And this is simply how you define your higher time frame bias. And then we can play out this day, and we dump taking out all these lows, even this low all the way to the left of us here. If we go on the weekly time frame, you can see that this was a weekly low in the market, and this was just simply a really, really bearish day. So now that you have your higher time frame bias down, you now want to take your entry model. So I'm going to show you a really easy way to just find the higher time frame narrative and draw on liquidity. But in order to take this entry model, you need to find the right key level. And this is where price is going to be bouncing off, so you can actually take your entry. A lot of people have the right bias and draw on liquidity, but they enter off the wrong key levels, finding them to get stop rated and then seeing price go in their right direction. And this can be very, very frustrating. So now I'm going to show you step 2, which fixes exactly that problem. Okay, to find a key level, I really only care about one thing in the market, and that is fair value gaps. And I can use 2 different scenarios when it comes to fair value gaps, that being either an unmitigated fair value gap, meaning just a fair value gap that hasn't been traded into yet, or a fair value gap that's already been traded into, and I'll use the high or the low inside of that level as my key level. Now, that might sound confusing right now, but I'm going to draw out some scenarios so you guys get a better understanding of what this key level looks like. So again, let's just write this out. Number 1, a key level can either be an unmitigated fair value gap, and the time frames I'm going to use is the 5-minute and above. Or for my key level, I can use an intermediate high or an intermediate low inside of a fair value gap on the 5-minute time frame and above. So if you guys don't know what fair value gaps are, I highly recommend, again, you guys going to that course video that I have linked in the description below for the free course. But if you guys do know what a fair value gap is, right, so this will either be an unmitigated fair value gap, so just a fair value gap that hasn't been traded into yet, and it looks something like this. You can clearly see on this 15-minute time frame, we have these fair value gaps right here. I'm also using this indicator FVG by Nephew Sam. If you guys are too lazy to just mark them out yourself, this is a great indicator that marks them out for you. So we can use these levels as our key levels. Let's say we're really bullish on the higher time frame and we want to be looking for longs. Well, then all we need to wait for price to do is simply trade into this key level. Now, the next key level I'll use is intermediate lows and highs. Now, intermediate lows and highs are simply just highs or lows resting within a fair value gap. So let's say this fair value gap has already been mitigated, has already been traded into, and now we start trading away from it. Well, I can't use this level again for price to bounce off as my key level because this fair value gap has already been traded into. So for me to have a valid key level and for price to have an accurate way of bouncing off, I need to be trading off of this intermediate low resting within the gap, the lowest point inside of this fair value gap, or an intermediate high if this is a bearish scenario. So once this low gets taken, this is our valid key level that we can be using. And then we could assume if we get our entry confirmation, which I'm going to show you in a second here, that price is going to deliver in the corresponding way. And a chart example of this looks something like this. You can clearly see that we have a bullish fair value gap and price is super bullish. So for me to actually take an entry on the lower time frame, like the 1 minute to 5 minute, I'm going to need to see this low inside of this fair value gap get hit before taking my entry. So we just simply wait for this low to get hit. And as you can see, we start delivering up from that low. We can target, for example, the next level of buy side liquidity up here. And this was using the intermediate low inside of this fair value gap. So these are really, again, the only two key levels that I use, either an unmitigated fair value gap, so you can take your initial longs off there. Let's say you don't get an entry. Maybe you can take a long off something like this, which would be too premium in this scenario, right? Or you could just wait for that intermediate low inside of this gap to get hit. So this is where it becomes really important to start defining your bias before you even define your key levels. Because if you can define, okay, I have a bullish bias in the higher time frame, then you can just sit on, you know, the 5-minute, the 15-minute time frame and wait for these fair value gaps to get traded into, wait for these key levels to get hit, and then we can focus on the actual entry model later on, which I'm going to get into in just about a second here. Now, guys, with this information that I'm giving you and with all these rules that I'm giving you, please understand that this is, again, a very mechanical set of rules, and it will yield you a very high win rate if you follow them. But with that, probably a pretty low trade frequency. And after you have years of experience under your belt and you start trading a little bit more discretionary, you can start refining things to the model and start adding little rules here and there. And that's what I do to this day. Again, all these rules that I'm going to give you and all these rules that I have given you, I still use and apply to this day. Don't get me wrong. But with that, I'm always refining my model and refining my edge and still applying discretion and intuition in my trading with that. And that will come the more you trade, the more you journal, the more you backtest. That intuition and discretion will come. So now let's get into step 3, which is essentially what the whole model is revolved around. And this step is to wait for your inversion for value gap as your confirmation. Now, you've probably had this happen to you before. You define your bias, price taps into your key level, and then you just enter. Maybe it goes in your way for a little bit of time, and then price just dumps or pumps, stopping you out, and then it'll actually go in your direction. And this is manipulation in the markets, and this happens to traders all of the time. And it is because they are not waiting for proper confirmation in the markets. Now, this used to happen to me all the time, which is why waiting for an entry confirmation before you enter into any trade is so important. Because as a beginner trader, this really gives you that discipline to just sit on your hands and wait for the market to come to you, rather than you just basically entering off of emotions and FOMO and being super trigger happy. And the inversion for value gap pretty much removes all of these emotions. And it's exactly what led me to have this amount of discipline to this day. An inversion for value gap is simply when the market runs through a fair value gap or disrespects it. And I've shown you what that looks like. For example, here we have a 5-minute bullish fair value gap, and we are pretty much in a downtrend. As you can see, the market is making lower lows and lower highs. So we want to be on side of this downtrend and just trading with the trend. Again, I can't emphasize how important it is to trade with the trend. So many traders trade against the trend, and it's why you lose so many of your trades. But with that being said, as you can clearly see, we have a bullish fair value gap, and if we're going to be bearish, then the market should trade through this, and we should get a body that closes below this fair value gap. And as you can see here, we just wait for the 5-minute entry model right here. And if it's a 5-minute fair value gap, what do I wait for? A 5-minute closure. That is really, really important. Now, something that's also really important with this is that you take the highest time frame inversion. Now, as you get to more of a discretionary level, you can sometimes go by a lower time frame inversion. But to this day, I would still say about like 80 to 90% of my trades, I'm still taking with the highest time frame inversion. And the reasoning for that is because we can have an inversion happen on, for example, let's say the 3-minute time frame. Let's say this 3-minute gap got closed through right here, but then sometimes price will hold the higher time frame for value gap, like this 5-minute, and then even though that 3-minute closed, the 5-minute didn't, and then price will run in the opposite direction. So yes, sometimes if you have like a super clear narrative in the market, a really obvious draw on liquidity, you can take a lower time frame for value gap entry, but I highly recommend that you take the highest time frame inversion in the leg. And what I mean by in the leg is simply the manipulation leg. So we can start combining things that we've previously talked about, for example, key levels. As you can see here on the hourly time frame, we have an hourly bearish fair value gap. And for me to define now what's going to be my entry model, what's going to be my inversion, I'm going to look at the manipulation leg from the low to the high that hit my key level. So what that looks like is looking at this low here and then this high here. This is the high that hit the key level, and then this is the low that pretty much sponsored this move, that made this move happen, right? And this is our manipulation move, because the market is manipulating traders into thinking that we are going to continue going higher. But in reality, again, this is just manipulation. We are filling orders here at this fair value gap, and then we wait for our entry confirmation through a 5-minute gap getting disrespected, confirming that order flow switch, and then you take your entry right here. And I hope you guys are starting to realize that the same way we find our bias is the same way I find my entry. And I'm just looking at the higher time frame models, and I'm trying to put that into the lower time frame models, because at the end of the day, price is fractal, meaning what's happening on the higher time frame is also happening on the lower time frame. But yeah, this is essentially your green light light to actually enter into the markets. You don't wait for a limit order, you just simply enter with a market order and enter right when that candle closes. Now, the second and final step here is to target high quality liquidity pools. Now, this is really important because you can have your bias, right? You can have your entry model, you can have your key level, but if you don't know where to place your take profit, then you're going to give all of that money right back to the markets. This is why you need to know your exact targets before you even think about entering into a trade. Again, reverse engineering around the entry model is really, really important. So let me show you guys what these high quality targets look like on the charts. All right, now these are the targets that I want you guys to be looking for when trading the Mech model. Okay, so you're going to be targeting relative equal highs and lows in the market, and this is pretty much exactly what it sounds like when we have a high in the market and then we leave a relative equal high. And this is also called a failure swing. You'll often see people refer to it as that, or a relative equal low in the market where we have a low put in place and then the next low doesn't take out that previous low and we make relative equal lows. We have a failure swing there, and then this is a great target for price to then go back to. Now, another target that we talked about that it's also used as a key level that's great is 15-minute and higher intermediate highs and lows, because a lot of stop losses are actually resting at this level, right? People are taking longs from this area and then putting their stops where? At these lows, at this intermediate low inside of this gap. So targeting this is actually a really great draw on liquidity. Next up here, I have session liquidity, and this is just going to be in the form of London highs and London lows and Asia highs and Asia lows. And this is also tying into just time-based liquidity. So previous day highs, previous day lows, you have weekly highs, weekly lows, even monthly targets sometimes. If we are trending towards that, those can be great targets to have. Next up, I have here unfilled 5 minutes and 15-minute for rally gaps. This is a really, really great target if used correctly, because the market moves from what? External liquidity to internal liquidity, meaning we are taking out buy side and then we are rebalancing the market, and then we are taking out buy side or sell side, rebalancing the market. And this is just how the market moves from internal to external, from external to internal. So trading this leg right here is really, really great because you can trade that rebalance in the market. And let's say price is going to be truly bearish. Well, you can hold a runner for all of this move that happens right here, and you can catch pretty much like the top. Or let's say you were just overall wrong, you still probably hit a 1-to-1, could have taken profits, or you got break even and price just goes to the opposite way. But just trading this manipulation move can be really beneficial at times. And the default target I want you guys to go for is just shooting for around a 1-to-1 risk to reward. Just targeting these levels around a 1-to-1 is really great. You don't need to go for 1-to-10 risk to rewards that you see all those people on TikTok, because at the end of the day, if you are like me and you're trading with prop firms, a lot of these prop firms require consistency rules. For example, 30 to 40 to 50%. And if you have like a pretty low win rate and you're shooting for super high RR trades, these prop firms are not going to want to pay you out because they're looking for people that can trade consistently and that can have consistent winning days. And by taking, you know, those base hits, that low hanging fruit of just taking trades around a 1-to-1 risk to reward, you will have way better consistency and you will actually start to rinse these prop firms. And finally, I just have here with extreme confidence and very clear structure, you can hold runners towards, you know, 1-to-3s, 1-to-4s if you're trading on a live account or if you're trading with a prop firm that doesn't require any consistency rules. But I would just suggest to not look for runners in every trade. It is very, very rare, honestly, for me to hold any sort of runners. I used to before, but I just find it kind of cooked my risk to reward. And I really just shoot for those 1-to-1s, and I don't really hold any runners personally. And it's what personally works best in my trading. Now, with all this being said, of course, these are the best targets to have, but that doesn't mean just because you have this target, you should be targeting it. Now, what I mean by that is that these targets should all align with the higher time frame trend. Let's say the higher time frame trend looks like this, and we are really, really bullish. We're in a super fat uptrend. But then maybe we have, let's say, an unfilled 5-minute for rally gap right here. And again, let's say the draw on liquidity is still higher. We still have targets up here, and price is clearly just ripping higher. Well, as a trader, I'm not going to want to take a short and try to target this unfilled 5-minute gap just because it's a target, right? I want to be targeting the unfilled gaps and maybe the session liquidity that's aligned with my higher time frame bias. So let's say we have London highs right here. Okay, then I'm going to be looking to target London highs here, not London lows down here, because that's not aligned with my higher time frame bias. Now, there are times where, you know, the lower time frame could be really, really clear and you could just get a little scalp towards there. But I always think that the highest probability entries and the best, most A+ setups come with just trading that higher time frame trend. So please just try to focus on that. Now, the fifth and final step of the Mech model is to execute flawlessly. I'm going to show you how to place your stop loss, your take profit, and the highest probability areas. And if you have all of the other steps down, this is going to be the easiest part. And I'm going to walk you through a real-time trade that I took so you can understand the whole entire picture. So let's get into it. So I'm going to show you guys this short setup that I took. This was a trade that I took this week. This was on Thursday, February 5th. And first things first, what am I going to do is I'm going to determine my higher time frame bias and trend. Well, if we just go on the 4-hour time frame, what are we doing, guys? We are just very clearly dumping. I don't want you guys to overcomplicate your bias, because at the end of the day, it can be just very simple. If you see the market just dumping, you see the daily, we are just literally dumping towards lows like this. This is a very, very obvious draw and a very clear signal that the market is going lower. So as traders, right, we can look at the daily time frame, we can look at the weekly time frame, and we can just clearly mark out these levels. So let's just look at the 4-hour time frame here. And what are some just easy levels that we can mark out? Well, we can see that we have this swing low right here on the 4-hour. This is a level. We also have a low right here in the market. So for me to take an actual entry model, what am I going to be looking for? So what are we doing? We are clearly delivering from what? Buy side liquidity, right? If we just go on like the 30-minute time frame here, we are delivering from buy side. We have, you know, these swing highs here. They're getting respected. We are delivering from them. We are clearly respecting bearish fair value gaps here. You see on the 30-minute time frame, we are respecting bearish. And what are we doing with the bullish gaps? We are just running through them. You see on the 15-minute time frame that we are just disrespecting all these bearish gaps in this leg. And this is the current state of price action. And I'm usually determining my bias anywhere from 15 minutes to an hour before the market actually opens. So like anywhere from like 8:30 to 9:15, you know, I'm just determining my bias in that way. So as you can see, again, we're trending lower, and you can see that we are trending towards lows in the markets that's resting around here, around over here. So for me to now take my entry model, I need to have a key level, right? That's step number 2 in the model. Now, a key level in the market is simply going to be a fair value gap. So there's really going to be like 3 main scenarios every single day. This is like the exact same thing I'm looking for every single day, depending on my bias. If we're going to be bearish on the day, I'd want to see price have an open high and trade higher, trade into a key level, and then deliver lower. Or sometimes open can just simply deliver lower. From there, I'll wait for a 5-minute or 15-minute gap to open up, take shorts from there, wait for that fair value gap there. Or sometimes we might manipulate both sides of the market. So we might go down first, then we might go up, and then we might go back down again. So I'm just going to be simply waiting for any of those 3 scenarios to happen for me to take a trade. So now that we're getting close to 9:30 open here, we can just play this out. I'm gonna be staying on the 1-minute time frame here, and now I'm just gonna be marking out some basic levels, right? We have this internal liquidity pool here on the 1-minute. We can go on the 15-minute time frame. What is this? A 15-minute intermediate high, meaning what, right? We are not going to be taking, again, shorts if price does come up to this level and does something like this, right? Because I want to see the high inside of this gap get hit, because we already manipulated into this area, right? And this is also what? An hourly bearish fair value gap. As you can see here, if we go on the hourly time frame, this is not only a 15-minute intermediate high, but this is also a 1-hour bearish fair value gap. So we can mark this out with this line right here, a 1-hour fair value gap. And now I'm just simply going to wait for open to happen, right? So we can just play out price here, and we have open. Okay, so we can see that price did manipulate lower, but we didn't take out any major draws on liquidity, right? You see that we still left all of these lows intact on the higher time frame. If we go on the 4-hour, right, we still left this 4-hour low. And I believe this is also a weekly low, right? So you can see this is, if we go on the weekly time frame here, you can see that this is a low on the weekly time frame. So weekly sell side liquidity. And even though it's not like a swing low, weekly lows like this are really, really obvious and great draws on liquidity to have. But with that, what do we also have? We still have like this main external low in the market that's, you know, around like 600 points away, but we can just use this as a magnet in price, right? We don't have to necessarily target all the way down here, but we can assume that the market is eventually going to be drawing towards there. And then this is simply going to be a magnet for our lower time frame entries. So now we're playing out open here. It's 9:30, right? And I'm just simply going to be waiting either for 2 scenarios. Again, scenario number 1 is we keep delivering lower, and then we get maybe a 5-minute gap open up, 15-minute gap open up. Then I'll take a short from there, acting as a key level. Or we manipulate higher, which is like always going to be like the most A+++ scenario, because you're getting that manipulation, prices, you know, more discount of the range. You're not trading super low, and we just simply wait for that. And what do we do here? We trade into this hourly gap, and then price does eventually start delivering lower. Now, what inversion am I going to use here, Blake? There's so many fair value gaps in this leg. There's a fair value gap right here. There is another bullish fair value gap down here. You know, there's a bunch of gaps to use. Well, I'm going to look at the highest time frame value gap in the leg. Now, sometimes the manipulation leg can actually be on like the really lower time frame. So let's say we have like a fair value gap right here. If I'm really confident in the trade, I could take a short setup from here. Let's say there was a fair value gap here on like the 1 minute or like the 30-second. And this is still considered the highest time frame in the leg because it's just that last manipulation move that happens. And let's say we just don't get that entry. Well, I'm going to just wait for the main manipulation leg on the 1 minute to 5 minute time frame. So we see here we have this swing low, we have this swing high, and this is that main manipulation leg. So the 1 minute, there's obviously multiple fair value gaps. I want to find a time frame that there's only a singular fair value gap in that leg. So we can go on the 2 minute. There's no fair value gaps here on the 2 minute. Let's go on the 3 minute. There is a really small fair value gap, as you guys can see here on the 3 minute time frame. But I'm also going to be looking at more time frames, like the 4 minute. Is there a 4 minute? No. Is there a 5 minute? Yes. And really, that's like the highest time frame I'll use. I don't really go on the 6 or 7. Here come all the 6 or 7 comments. But the 5 minute is really like the most amount of confirmation that I'll need in the trade, right? Because again, if we have all of the other confluences aligned, like our bias, our higher time frame draw and liquidity, I'm not going to be waiting for such a higher time frame inversion to happen. A 5 minute in this leg, that's just the amount of confirmation that I need in order to take a setup. So what I'm going to do here is just simply wait for this bullish gap to get ran through. And as you see here, we close right through it. And then I'm going to take my order right here. It really depends every time on my stop loss. Like it's different every time. Sometimes if I get like a really good entry, I can put it at the top of the swing high. But if we get a close like this, where there's such a massive amount of displacement, I can put a stop loss at this candle's high. Or if I want to be really safe, maybe I can put it at like this 1 minute order block right here. But for this setup here, I did just put it at this candle's high because again, with this amount of displacement, I don't really want to see price trading all the way back up here. It's not really necessary. I'm expecting price to just dump from here. For the take profit, you can put it at just this low hanging fruit. It's resting around a 1-to-1. And for this trade, personally, I wanted to have a little bit better of risk reward. So I did put it for that weekly sell side. And this is still considered, you know, for those high quality targets. And for a high quality target, what is this? This is technically relative equal lows on the higher time frame, right? We have a low here, and then this is a failure swing where we don't take out this low here. And then I'm typically going to want to go break even at the manipulation leg low. And then if we play this out, price absolutely dumps right to my TP. I did post a trade recap on this exact trade on my channel if you guys want to go check that out as well. But this was just a quick summary of that trade. Now, I just given you guys the whole entire framework that I use for this Mech model. And it's what I use in order to take these high probability trades and make 5 to 6 figures per month with day trading. But what's most important after watching this video is that you take action. Don't just watch this video and then do nothing. I want you guys to start backtesting 1 week worth of data every single day with this model. So you can see for yourself that 70 to 80% win rate that you can get by just literally following this simple set of rules. And it's really important that you just trust the system overall and execute on it no matter what. Like I was saying, trading is just like a video game where you can't really control the outcome of the game, whether or not you die or you kill everyone in the lobby. It's the same way with trading where you can't control the outcome on whether or not you win or you lose a trade. The only thing that you have control over is whether or not you followed the system and whether or not you had conviction for that setup. And that conviction comes from backtesting, comes from spending actual time in the markets taking trades with this model, comes from journaling your trades every single day. With that, also, please start journaling if you haven't done so already. I just recently partnered with TradeZilla. They're a journaling platform that I personally use in order to journal all of my trades. By far the best journaling software in the market right now for trading. So go check that out if you haven't signed up with them already, and just keep fucking going. You might see a day or two in these markets where the setup is not presenting itself, and that is completely normal. Not every strategy presents itself every single day, especially those with a higher win rate. And just understand that the market is always going to be testing you. It's testing you in times where the model might not work. It might lose a trade. It's also testing you in times where the model is working flawlessly and you will have banger weeks after weeks. And it's testing you whether or not you're gonna size up or you're gonna get overconfident. So in order to remove those emotions that the market is putting on you intentionally for you to fail, you focus on the mechanical system that you have in front of you, the checklist that you wrote down in order to take your setups, and just stay on side of that winning statistic. And that is the #1 advice that I give to pretty much any trader out there. With that being said, this was the full system that I used that took me from losing a bunch of money in my college dorm room to now becoming a millionaire from day trading, driving my dream car, living in my dream apartment at 21 years old. And the final thing that I want to implant into your guys' brain is that you are no different from me. I started with nothing, blew multiple fundeds, and wasted over a year getting literally nowhere. I kept looking for something new and for a new cheat code that I can just type in. But at the end of the day, it's not about finding the best strategy. It's about finding a consistent one and having a consistent edge in the markets that you understand and executing it with discipline every single day. So if you take everything I told you from this video and actually put it into practice and take action, you can start seeing results just like my boy Solace, who has withdrawn over $50,000 in 2026 so far. Or people like Ivan, who's already requested 4 payouts in 2026. And if you're ready to take the next step and work with me one-on-one, click the first link in the description below to apply. And thank you all so much for watching.